Hello, everyone. Welcome to Capital Link's virtual investor forum. So I'm Randy Giveans, head of the Maritime Shipping Equity Research Group here at Jefferies. Today we have a star-studded panel of 5 of the top executives in one of the most global industries around the world, dry bulk shipping. So on the panel today, we have Mr. Martyn Wade, CEO of Grindrod Shipping Holdings. Martyn, if you want to wait. Dr. Loucas Barmparis, President and Director of SBLK. There he is. Mr. Robert Bugbee, President of Scorpio Bunkers. Mr. Stamatis and Tsantanis, Chairman and CEO of Seanergy Maritime Holdings. And Mr. Hamish Norton, President of Star Bulk Carriers. Awesome. Well, we have plenty to discuss and only about 40 minutes to do so. So let's jump right in. You know, clearly, dry bulk market remains weak. We've seen headline Capesize rates under 10,000 a day all year, currently below 4,000 a day. Obviously, we expected some seasonal weakness with Chinese New Year, and then have heard that Chinese iron ore and soybean imports were actually up kind of during this time. However, obviously with coronavirus, economies shutting down pretty much literally around the world. How do we compare this kind of current weak market that we saw to the weak market last year in the first quarter of 2019 following the Barracuda dam failure in Brazil? So I guess, Hamish, we'll start with you since you have the most Capesizes on the panel.
Yes, that is true, and for the moment, unfortunately true. Hopefully that changes. So, you know, the dry bulk market always experiences a seasonal dip in the first quarter, and you know, basically 46% of dry bulk cargoes move in the first half versus 54 in the second half. So this is not a complete shock. But, you know, Brazilian iron ore exports are one of the main drivers, and they are down. You know, obviously last year, the dam failure accentuated the downturn in first half iron ore cargoes. And so, you know, the comparison to last year is a bit, let's say, misleading because last year was such a low base. You know, the other thing that's affected charter rates is that the switch to expensive compliant fuel caused time charter equivalent rates to drop, you know, as voyage rates, at least for a while, were flat. You know, there was a series of disruptions in Brazil and Australia, and, you know, it looks to us like, you know, Brazil and Australia iron ore exports were down something like 10% year on year during January and February. But, you know, COVID-19 is affecting all nations. It's certainly affecting Brazil at this point, somewhat affecting Australia. So, you know, it's an inevitable disruption, and hopefully it reverses quickly.
Sure. Well, yeah, you know, spot rates could obviously significantly improve with a economic recovery kind of post COVID-19, you know, if and when, obviously we get to that here, hopefully sooner rather than later. But the 1 year, 3 year time charter rates currently around where they were at this time a year ago, right? So how has the operational strategy kind of changed in terms of spot versus term business? And is there much liquidity in the 1, 2, maybe 3 year time charter market? So Stamatis, I'll have you kind of start on this, and if others, again, want to chime in, feel free to do so.
Well, thank you, Randy. First of all, if I may add to what Hamish just said, demand for iron ore continues to be very strong. We see the iron ore prices in China, both spot and the futures, to be one of the highest. They're hovering between $85 and $90 per ton. So, you know, price is an indicator that demand for iron ore, and especially the higher quality of iron ore coming out of Brazil, remains very strong. And, you know, a second Hamish's point about Brazilian export. So I'm sure that once the Brazilian export situation normalizes again, we will see a very, very strong recovery in the rates. Going to your question now about spot and period rates, unfortunately, there's no such thing as a period market. I mean, outside from whatever area the FFAs are covering, which is usually short term, anywhere between, let's say, 6 and 12 months or something like that, we do not really see any long-term demand for period right now. So, you know, we're all talking about spot market these days.
Yeah, and just to add to what Stamatis said, you know, even if there were liquidity in the period market, in the dry bulk business, you have to be extremely concerned about the credit of your charterer, and the longer the term of the charter, the more concerned you have to be about the credit. You know, the credits in the dry bulk chartering market are not often as good as the credits in the longer term tanker chartering market. Obviously, there are exceptions. There are the large mining companies, the large utilities, but most charterers one would have to be very cautious about.
I agree with that.
All right, you know, looking into some demand topics, obviously, given the 21-day shutdown being implemented by India, how meaningful will this be for Indian coal imports here in the second quarter? And then in contrast, China seems to be starting to see some recovery, right? So what are you seeing in terms of import activity into China? Loucas, what are your thoughts here?
Look, I mean, we have people in China and we monitor the situation very closely. I think that China is in a recovery mode right now, and gradually they are introducing they stopped the internal transportation difficulty that we used to have in the past, and only people coming from abroad have this 14 days quarantine. And it seems that China, the Chinese trade is improving. In India, it's something which is somehow new, and we want to see how this will develop. We think that at the end of the day, all the importing countries will have to operate from some point and onwards. So even if there is a disruption, this disruption will stay for let's say maybe a few weeks or a few days, and then there will be solutions.
Can I just add that, Andy? It's interesting because, of course, we're getting a knee-jerk reaction. Every country suddenly goes 21 days. India, South Africa announced a few days ago. And then I think governments realise that there are strategic cargoes. I mean, in India's case, they've got to keep the lights on, they've got to feed people, similar to South Africa. So I think what governments are having to do is then make a call on what is strategic, what do we need to import, export. Obviously, foreign currency for some of these countries is very important. But I think it's still early days. But I agree with Loucas. We're in for a couple of weeks of disruption before countries work out. For someone like India, they need the electricity. And if nothing else on this market, you've got to feed your people and keep the electricity on.
Yeah, that's fair. All right, hey Robert. Given the quarantine lockdown, you know, China is still increasing their imports of pork while the sow herd continues to recover from the swine flu. So, are you seeing a continued impact on soybean demand, or is there a substitution effect happening with that product?
Well, we're seeing good, encouraging signs so far from the new Brazilian crop. That exports there are certainly moving up from last year. We can see just generally in the rates of the smaller vessels, whether they're handies or ultramaxes, that those markets are certainly benefiting from the increasing activity from China. And so in that sense, that's some form of optimism that to echo the other speakers, that China is keeping the lights on. China is feeding its people, and China is now trying to get their economy and their work and manufacturing up. So You know, we faced these crises before in an industry. I think every single speaker has been in, you know, obviously not the same situation, but similar situations in shipping markets, and we all just have to find a way to get through it. And the optimism for this is that, you know, the central governments, and as we go through, will be hell bent on keeping employment, and as the previous speakers have said, feeding their population and moving forward.
Yeah, Martyn, kind of back to you. Obviously, Grindrod focusing on the handy size, Supermax sectors. So there seems to be some maybe unrest at some of the South American grain exporting ports. So is there still a risk that coronavirus causes some disruptions there in Brazil and Argentina? And how serious is this to the grain trade?
Well, obviously, if it does develop, it's going to be very serious. I see that certain Argentinian terminals decided they were going to ban all ships, but the government, central government, basically overruled that. So provided the countries in the background are actually talking to the people and being honest with the population about the spread of this disease, what it actually means, I would hope it would go ahead. And a lot of these terminals are pretty automated these days, so the actual risk should be minimal. Obviously, ships coming in, all the crew stay on board. There's none there, so it's their own staff in the terminals. But one would hope, and to say, places like Argentina, Brazil need this foreign currency very importantly. So I've got to believe that the governments will be doing everything they can in a calm manner, because you can't even imagine what would happen to the market if they did switch those terminals off, even for a few months.
Yeah.
Even if what I want to say is that the trip to Argentina or Brazil, it's I mean several weeks. So I mean it's quite extensive. So I think that people will understand at a certain point of time that it does make sense to have some people in quarantine, or to have some vessels stopped in the ports and not exporting.
Yeah, and of course, none of these ports are closed at the moment. You know, they're all operating as far as we can see.
Sure. All right. You know, obviously, we've talked a lot about demand, a lot of uncertainty. Fortunately, we have a little more visibility, I guess, around supply. So we've seen some accelerated scrapping during January, February, compared to the previous couple of years, especially during the first quarter. So given where rates are today and the uncertainty, as we discussed, around dry bulk demand, do you believe we'll see further scrapping here in the first half of the year? Kind of Hamish, I'll have you start on this.
Sure. Well, you know, look, I think in a normal situation with the market at these levels, you would see a lot of scrapping. And, you know, the problem we're having is that Pakistani, Indian, and Bangladeshi scrapyards are basically shut. And sure, they're essentially shut because the governments involved don't want the crews passing through their country. You know, although I can't imagine the crews are carrying more of the COVID-19 virus than is already in those countries already, but nevertheless, that's the strategy they seem to be taking. So at least for the time being, you cannot really scrap a ship in any of these countries, which are the highest bidders for scrap steel. You know, I would guess that changes pretty quickly and that we will see a bunch of scrapping, but for the moment, it's basically stopped.
Okay. Hey, Loucas, you know, Safe Bulkers has that resale with delivery expected soon. So obviously you might have the most insight on this call in terms of several slowdowns, delays at these Chinese shipyards due to the kind of quarantine and the lockdown efforts in the last couple of weeks and months. So how is this kind of affecting delivery schedules? How long are these current delays lasting? And then how might this kind of help support rates here in the next few months and quarters? So both delays on the new build construction as well as on maybe scrubber retrofits and dry dockings and all these other things. So Loucas, if you want to start, and if anyone else has color,
Yes.
feel free to.
Yeah, we have a very good insight on that. First of all, our vessel, this is a vessel will be delivered in about mid of April without any delay. But I expect in general there will be delays because the production in China was, especially in China, the production was interrupted. And so you could, in certain occasions, you couldn't even move paints from the one side to the other. So if you want to do a repair, for example, you want some paints, maybe you couldn't get them. I think that these 2-3 months that have passed the Chinese New Year and until now, it was clear that only a few jobs were undertaken by Chinese shipyards, also in terms of scrubber fittings. And gradually, I think that right now, shipyards are coming back to the normal operation by having lifted the quarantine for Chinese people, the internal quarantine for Chinese people of 14 days that used to have. Right now, I think shipyards have, let's say, the full personnel, and they can cope with the, with the gradual increasing demand for dry dockings, etc., etc. But this will take some time more. So I believe that the second quarter there will be also quite certain delays. In the third quarter, the situation will be normalized. In terms of deliveries, I think that there will be delays in new ships.
Okay. Anyone else have some color on maybe scrubber retrofit delays or ballast water treatment systems, dry docking delays, anything like that?
Well, you know, we're just finishing up our scrubber installation program, and you know, we expect to be done with it by the end of April. Certainly, there have been a tremendous number of delays. You know, that's getting a lot better. The shipyards seem to be mostly back to work, and you know, I expect that it's not going to be a problem very much going forward. And you know, we note that the number of ships that are getting scrubbers installed now sort of peaked in January and is headed down.
Robert, any color on scrubber installations?
Oh, I would expect generally in shipping they would slow down. I think that, you know, that would be not because of the yard's capacity. I would agree that with all the speakers that the yards will, you know, become more efficient and more capacity, but with fuel oil prices where they are and where the spread is, I think there would be less urgency for people to put scrubbers on in the short term, and they would seek to delay where they can those scrubbers just simply on a preservation of cash basis. And I expect to see that across the industry, in tankers and in dry too.
Yep. All right, you know, Robert, while we have you here, you know, last month, Scorpio Bunkers announced the sale and leaseback agreements for, I think it was 3 vessels. 2 weeks ago, Salt sold 2 Ultramaxes and 1 Kamsarmax. So, few questions here. First, what was the kind of reasoning behind these transactions? Second, are sale and leasebacks an attractive method for capital raising and vessel financing? And then third, how have asset values been impacted by the recent market weakness?
Okay, so when we first saw the signs of corona, you know, the potential for coronavirus, we, you know, we literally decided to, you know, promptly strengthen the balance sheet. So the quickest way to strengthen the balance sheet was to do a combination of sale, leasebacks, and sales, and you know that we felt was the right thing to do as quick as possible. because we still, even today, are uncertain about the longevity of this. And the first thing to do is, as the speakers have said before, you can't really depend on the time charter market in dry cargo, and you have to simply make sure that you have adequate liquidity, cash on hand. So those were the reasons for doing what we did. I think what's interesting when it comes to the third question is not so much pricing. I mean, pricing will be discovered along the way here, in that what I think is interesting in the market at the moment is that whereas at the end of November, December, there were very few what I would call traditional cash buyers. I think one of the great hopes for the industry is there seem to be a lot of cash buyers around at the moment looking for bargains because they see the long-term recovery. Obviously, they would be looking at, you know, discounted prices, but I think that that's a positive sign that we're seeing, you know, cash buyers come out of the woodwork in the industry. And as companies, you know, if companies have, there may be less for sale this time compared to 2015, simply because so many of the public companies, including ourselves, don't have new building books. You know, we have fully funded balance sheets. We have balance sheets that are in better order. So I think that's, you know, that's where I would see some good strength in the industry at the moment.
Okay. Thanks for the color on that. Hey, Martyn, given the situation with COVID-19, you know, how have the day-to-day operations changed aboard the vessels? You know, should we expect any inefficiencies or expense increases related to either greater safety measures or precautions in the coming weeks and months?
Interesting question. It was, as it broke for us in Asia, obviously this kind of started middle of January, and we immediately went through our onboard protocols. We actually got hold of thermometers. Anyone that comes on board the ship, you limit, and you try and do it. Obviously, you've had crew on board for 3-4 months. They're absolutely corona-free. So that is the advantage. But going forward now, of course, it's the where you have to do crew changes. To actually physically quarantine crew beforehand is quite difficult. We're kind of doing what we can, and also extending crew as much as possible. But the other issue, of course, is with the decline in air travel, with more and more airlines packing up. How the hell do you actually get the crew to the ships and then off again? And I think, as Loucas referred to, I mean, certain countries, they don't want to take the crew. Sorry, it was Hamish. But on the basis they've been on board for so long, they're absolutely zero risk. So what we're exploring, people are exploring, is that how do you do quarantine from the airport to the ship and vice versa? So there are going to be inefficiencies. You are going to end up with ships with corona cases on board. And that means you could actually get dead ships, you know, literally not trading, which again is going to add to the mix of the market.
Sure. Thanks for the color there. All right, Stamatis, you know, IMO 2020 was the talk of the town, obviously, in 2019. Obviously, sent to the back burner here in the last few weeks and months with the tightness in the spreads, with everything else going on. That said, how has the new fuel regulation impacted dry bulk shipping? And what fuel procurement strategies or hedging strategies have you employed to maybe lock in some of those fuel spreads?
Well, first of all, for the non-scrubber fitted ships, I must say that the current levels of the very low sulfur fuel oil represent a unique buying opportunity. So we've seen them bouncing off the bottom quite some time. I don't want to take a position on where the Brent or the WTI is going to go, but surely at this kind of levels, you know, anywhere between 250 and 300, I think that the low sulfur fuels represent an amazing opportunity. Now, discussing about the strategy, I think it's a little bit unfair because we're living into a situation where there's market disruption all over the world. So we started the year at $700 a spread, sorry, $450 a spread at the time. So it was very good for us because without having paid for the scrubbers, we're getting a very hefty profit sharing. from the use of scrubbers. Right now, there's no such thing as a profit sharing, but at the current levels of the Capesize market, which is at $3,700 a day, whether you're making $3,700 for the non-scrubber fitted ships, or you're making $5,000 to $5,500 for the scrubber fitted ships, having paid millions of dollars for the installation, I think it's kind of a surreal discussion. We just need to wait and see where the overall market is going to stabilize and normalize, hopefully in the next few months, both as a combination of where the fuel spread is going to go, as well as where the rates will finally end up, hopefully soon.
Sure. All right. Hey, Loucas, have you seen obviously any increased demand or decreased demand for scrubbers with the whole tightening of the spread, although scrubbers apparently seem to be working well? And what are your thoughts on kind of fuel spreads going forward? Obviously, in a low commodity price environment, remain very tight, but do you expect an expansion here in the coming months?
Yes, look, I mean, we also are very close to complete our scrubber program, and 15 out of 20 scrubbers that we intended to install were in full operation the first quarter, and they made a lot of money with very good spreads, which now, as the demand for oil has dropped and the price has dropped, of course, the spread is low. It's quite significant still. What I believe is that as we move along, when the market improves and the demand of oil comes to be at normal levels, I believe that also the spread will go back to where it used to be, about 200 to 250. So I think that people who have installed the scrubbers will have, let's say, this very good payback that they have predicted for us. Of course, we followed a mixed strategy. So half of our fleet is with scrubbers, half of our fleet is without scrubbers. So let's say we are, risk averse, and we did both of those. The important thing for scrubbers is the operations. And I tend to believe that many people who have cut corners in their installations or in the selection, they will face difficulties in operations, which will be tremendous. They will face corrosion. And so I think that generally people who have installed scrubbers should be very careful and do very thorough checks in their scrubbers, if especially they haven't got them from a very well, let's say, a very known maker. So they may need to thoroughly check them, because sooner rather than later they will face problems.
And just to add to what Loucas said, at the moment, obviously, the spread is terrible, and it's related to low oil prices, and it's related to basically very low demand for diesel, gasoline, and jet fuel, which are the low sulfur transportation fuels. And there's a trade-off at the oil refinery between making low sulfur diesel, gasoline, and jet fuel and making low sulfur ship fuel. Right now the refinery is really happy to make lots of low sulfur ship fuel because it doesn't really have demand for the alternative low sulfur fuels. So that should change. The other thing that should change is the mix of heavy sour crudes in the world to light sweet crudes. The crude coming out of the United States is very light, very sweet crude, which produces very little high sulfur heavy fuel oil when it's refined. With the Saudis and the Russians pumping out oil as fast as they can, that's going to cause a lot of the light sweet crude coming out of the United States to stop flowing, and a lot of heavy sour crude from Saudi Arabia and Russia to flow at ever greater quantities, which is going to cause a lot more heavy high sulfur fuel oil to be produced. So, if we can make it through to the end of the coronavirus and see a resurgence in demand for diesel, gasoline, and jet fuel, I think the scrubbers will start to look good. In the meantime, though, I agree with Robert. People who haven't installed scrubbers are seeing how they can delay the installation and save the money.
Sure. That's fair. All right. Then looking at kind of capital allocation, in the last few weeks, shipping, dry bulk in particular, has been hit by some panic selling and investors shedding anything with energy related or China exposure or just global trade, right? So in terms of your capital allocation strategy, are any of you taking advantage of the pretty steep price to NAV discounts and repurchasing shares? Why or why not? Hamish, we'll start with you, and if anyone else has any additional color.
Sure. Look, if we were sitting on a big pile of cash, we would be thrilled to use it to buy back a big pile of shares. I wish we were sitting on more cash, but frankly, we like Robert at Scorpio Bunkers think the right thing to do is to strengthen our balance sheet right now. And as a result, we're not in the market buying back stock right now, even though spectacular buy.
Sure.
No,
Anyone else?
Yeah, Randy, I think that this is an exam facing us all in many ways. I mean, the biggest exam we have as executive is to try and keep all our people safe on board and shore. And the next exam is to try and keep our companies functioning, the operations of the companies functioning. And when it comes to those two, we have to perform excellently. The challenge is incredible. When it comes to the actual balance sheets of the companies and capital allocation, I think this is very simple. It's pass or fail. It's not about maximizing the opportunity for shareholder value right now. It's ensuring that the company gets through to a position where life is a little bit more predictable. And there will be an opportunity later. Generally, what would happen anyway is that the stocks are unlikely to trade at or above net asset value immediately, even if the whole COVID-19 environment changed to the positive. So there will always be the time to take advantage of that. But right now, it's very simply a pass-fail examination for the balance sheets.
Yeah, no, that's fair. We've gotten a lot of questions around cash burn and balance sheet and who is going to survive. So go ahead, Loucas.
Yes. Yeah, for safeguarders, we have an active program. I mean, we have done refinancing actions towards the end of the year. So basically, we have done our homework towards the end of the year. So we have an active program. We did buybacks of prefers. We did, and we have a continuous active program on buyback of common stock, which we recently expanded also through a press release that we have published. We feel that the price of our stock is extremely low compared to the asset values and also to the opportunities that the market will offer when this situation will be resolved, maybe in a couple of or 3 months, if let's say all states take consistent measures against the COVID.
Sure. No, that's fair. Hey, Martyn, given the recent rate weakness and uncertainty surrounding economic recovery, will there be more opportunities for consolidation when that recovery comes? And do you think this will actually occur? How do you view consolidation in the space?
A hot topic, interesting topic, yes, because of course all the companies, the valuations are being destroyed and in fact incredibly cheap at the moment. But I think, as Robert said, price evaluation, NAV evaluation has still to be determined as we go over the next few months. I think it's premature. I think there's going to be a good opportunity of consolidation. And I would surmise that some companies who don't think they need to consolidate will be in that position where they're going to have to. So I have no doubt that strong companies who do survive with a shipping plan, i.e. ships, cargo, how you operate it, kind of get through this, will be in a good position. But it is really a survival, and opportunities will arise. But I think that will become apparent over the next few months in terms of who's in a position to go forward. And any consolidation, what you don't want to do, of course, is you do consolidate, make it even worse. If you're going to consolidate, it's 1 and 1 has got to equal 3. It equals 1.5 or even 2. That's not clever. So yes, great opportunity. I still think a little premature at the moment.
Okay. All right, we have 5 minutes to go, so we're going to do a 5-minute lightning round. So if each of you can answer each question in either one word or one number. So we'll keep it short. 5 questions, 5 answers to each. Starting with the first. What will dry bulk ton-mile demand growth or contraction be in 2020? Martyn?
I hate to say it, flat, I fear.
Loucas?
Flat.
Stamatis?
Well, I agree with flat, although I must say that if the first quarter of the first half, we actually saw a contraction or reduction, that means that, for the remaining of the year, we must see a massive surge in ton-mile demand. So, we're very optimistic for second half of the year, overall flat.
Yeah, kind of like what we saw last year. Robert?
No idea.
Hamish?
It's not going to be up.
Okay, flat to down slightly. Hamish, starting with you on the fleet growth, dry bulk net fleet growth in 2020.
Dry bulk net fleet growth, I'm more optimistic. I think as soon as India, Pakistan, and Bangladesh open up their scrap yards, there's going to be a fair amount of scrapping. So I think fleet growth net is going to be, order of 2%. And with the reduction in speeds, net fleet capacity is going to be flat from last year, including the effective speeds.
Yep. Robert, do you have an idea on this one?
Flat to down, and probably further down than Hamish is indicating, because I think you're going to have operational dislocation too.
Yeah.
Sure. Stamatis?
Well, I'm very optimistic on the larger sizes because, as we saw, VLOCs, Valemaxes, and the larger ships appear to be quite challenging in operations. We had another accident in Brazil, one of, 2016 Hyundai built, Valemax actually grounded, and I think that the whole bigger ship idea needs to be revisited, not just by Vale itself, but for the International Maritime Organization and the classification societies. Overall, I think, it's going to be much better this year for the bigger sizes, not so good for the smaller ones.
Okay, Loucas?
I think it will be up, let's say, the net increase by 1.5%. Of course, because the demand in the first, let's say, half will be substantially lower. The demand in the second half, because as I said, it will be almost flat, the demand curve. It will be substantially higher. So I think that there will be good opportunities, let's say, towards third to basically fourth quarter of next year, when most of the problems will be resolved.
Okay, Martyn?
I think it'll be marginally positive in overall fleet growth, maybe 1.5%. But again, as Robert said, others said, with the slowdown, the dislocations, and also in the back of my mind, I have a question mark about financing, anyone who hasn't tied it up. With what's going on in the cruise industry and the problem that's going to present banks, I think banks are going to start looking at their shipping portfolios, lending. So overall, I think it could be flat, in fact, maybe even be negative with all these factors put in together.
Sure. All right, a couple more quick questions. We'll keep these answers very short. Just give me a number. Average Capesize or Panamax, you pick one. Capesize or Panamax spot rate for the next 9 months. So the first 3 months, throw that out the window. The next 9 months average Capesize or Panamax spot rate. Right now, Capes are 4,000, Panas maybe 7.
Unscrubbed?
Martyn? Unscrubbed, no scrubbers, no scrubbers. Martyn, what you got?
Cape size, 12, 13,000.
Okay. Stamatis?
$20,000.
Wow, for Cape sizes, the next 9 months.
Yes.
Strong. Robert?
This is what happened. This is what happened last year.
Yeah, we saw it last year. I'm not saying it's not going to happen. Robert?
No idea.
All right. Hamish, play the game. Cape size Panamax average next 9 months.
Basically no idea, but you know, in the teens probably.
Okay, and then
I
Loucas.
think so, things.
I would say that for Panamax and post-Panamax that we care, it should be about, let's say, 11 to 12. For Capes, we have only one. In the spot market that we are chartered, I would say maybe it will be about 13 or 14.
Perfect. Awesome. Well, hey guys, thanks so much. I think we just ran out of time. So I just wanted to thank Capital Link for putting this together, the 5 panelists for answering all the questions, or at least most of them. And for those who are watching, if you have questions, feel free to add them into the networking lounge. We will respond to those questions, right now. As soon as you submit them, we already see a few here on the screen. And we look forward to networking with you here in the future. Hopefully we'll see you in person at the next Capital Link event. In the meantime, be safe, stay healthy. God bless y'all. Thanks.
Thanks, Randy.
Thank you, Randy.
Thank you.
Thanks all. Good luck, everybody.
Thanks.
And stay home, man.
Yeah.